All right, so you saved up a little bit of money, congratulations, and you're eager to start investing, but you don't know where to begin. Maybe you heard about some companies, like those big companies like Nvidia or Google or Apple or Tesla or all those big names out there, and you're like, gosh, I wish I had invested in those things like 10 years ago or something. I'd probably be like a gazillionaire by now. Look, and I totally get it. If you're new to investing in all these things, it can seem really confusing and overwhelming at times. You're probably saying like, how do I buy a stock? Well, what is a stock to begin with? Do I just like walk into the Apple store down in the mall and say, hey, I'm here to see Tim Cook. I need to buy some stock. Then there's the other group about the Bitcoin and the doggy coin and some pet poodle coin. And they're like, oh, it never ends. Then we have the part where you heard that it could be a little risky and you could lose all your money, and that anxiety that you get makes you a little bit hesitant to start investing. Well, hopefully I can clear all of these things up for you today, and you can feel a lot more comfortable by the time we're done. And to be honest, this is the video I probably wish I had about 15 years ago when I had just started thinking about investing. I wish I had someone to guide me, and that's exactly what I'm going to try to do for you today. Now, before we even start talking about the financial part of it and the financial investing, let me first tell you something really important that I've really learned along the way. And don't take this lightly. See, I realized that we only get one shot at life, right? We get one human body, we get one mind. The best thing that you can ever invest in is yourself. What you're doing right now, you're watching a video hoping to get some more knowledge, and this by itself is investing in yourself. You know, you're trying to better yourself, and you're actually doing something that is creative and informative instead of watching, you know, some Netflix series, the new Netflix series that everybody's talking about. So you chose to do something better, and that is investing in yourself. So, you know, congratulations to you for that. Now, the investing part. The first thing I want you to know is that if you have a little bit of money saved up, the last place you want to keep it in is in a savings account in some bank. Nowadays, the banks, they're paying like 0.01, 0.02% interest on your money. It's sitting there doing nothing. So then you may ask, okay, so where should I keep it? Well, a savings account is probably one of the worst places. What you should do instead is, and this is not financial advice, it's just my opinion on what I would do, I would open a self-directed investment account. You see, money over time loses value in terms of your purchasing power. Something that would have probably cost you like about 10 years ago, it cost you $1. Let's say like an ice cream bar or something like that. That would probably cost you around like what, $3 today? So in just 10 years, it went from $1 to $3. And why is that? Is it because the ice cream bar got more expensive? Well, yes. But in reality, what really happened is that your dollar lost purchasing power. You know what I mean? So that 10 years ago, had you gone to the store, you would have been able to buy that ice cream for $1. But now you need to lay out 3 of them just to get the same thing. At the end of the day, what should we do then? Okay, so if you have a little bit of money saved up, what you need to do is open an investment account and start investing right away. Where to start? Okay, so the best thing you can do, in my opinion, is to put your money in what's called an index fund. You're like, hey, Amit, what's an index fund? Okay, well, an index fund is, think about it like this. It's a basket of stocks like pooled together. Let's take the S&P 500, for example. You probably heard of the S&P 500, right? It's like the top 500 companies in the United States. They're all put into this basket and they call it an index fund. What happens is if you invest in something like this, you're actually minimizing the risk. Instead of putting all your money into just like one stock note. Maybe you heard about, okay, recently you heard like Apple is launching this new product and you wanted, I have $1,000 saved up and I'm going to just buy $1,000 worth of Apple shares. That might be a pretty risky thing to do. I've done it, okay? It could work out, it can, but that's really risky and I would not recommend you doing that, especially as you're just starting off. I would highly suggest you take your money, put it in an index fund, and just forget about it. You see, the reason why I'm saying this is that when you put it into an index fund, it gives you quite a bit of diversification in the sense that you're not totally dependent on one sector of the economy. So the index fund comprises of stocks like things in the tech sector and the energy sector, the oil sector, the consumer sector. If something happens in the economy and let's say oil prices go down and all the oil companies' stocks start to tank, your money is still put into different areas of the economy. So you won't see like your stock portfolio starting to just plummet. I just can't reiterate this enough that don't ever put all of your money into one stock. No matter what you hear about that company or how good it is performing at this any particular time, don't do it. At least not in the beginning, until you get some more experience and then you know that you're probably got some really good information. But that's for later on. You're now starting, you're a beginner investor. The best thing to do is go with the index fund. And the next question is, when should I start? Well, it's already too late. You should start right away. When you invest some money into stocks, there's this thing called the compound interest effect. Your money compounds over time. So the sooner you start investing, the more beneficial it's going to be for you in the long run. Something really important though, before you even start investing, I want you to make sure that you do a couple of things. You need to make sure that you have all of your high interest debt is paid off. If you have high interest debt, maybe you're owing on credit cards or you have like another student loan or something and you're paying really high interest on it, I would prefer and I would strongly say that you should try to pay that off before you even start taking that money and putting it into stocks or other types of investment. What's the reason I'm saying that? Okay, so let's say nowadays credit card interest rates are like really high. I know of some people who are paying well over 20% in credit card interest, which is crazy. Let's say let's take $1,000 for example. You take $1,000 and you put it into an index fund. Typically, let's say you make a 7% return or 8% return on that money. You made the 8% return, yeah, that's great, but you're paying 20-something% interest on your credit card debt. So would it be more wise to take that money and pay down your credit card, or would it be more wise to take that money and put it into an investment account? I want you to tell me, okay? So write me a comment or something. I promise you I will reply. Tell me what do you think makes more sense? Well, if you ask me, I would say pay out all your credit card debts first or any other debts that you're paying high interest on, and then start thinking about investing. Another thing, it's really, really smart to have a little bit of an emergency fund always put aside. It has unforeseen circumstances that come across, maybe a health emergency or some other type of emergency. Always keep a little bit of money put aside for an emergency and don't just take everything that you have and put it into some stock or something like that. The last thing you want to have to do is something happens and you have to pull that money out of the stock or the index fund, and you're going to end up losing money most of the time. Let's take a look at the chart of the S&P 500 and let's see how it performed over the past couple of years. Okay, so this is the S&P 500 index fund. As you can see, way back in 1987, this was like $242. If you go back a little more, it started off like about $100 way back when. Now, as you can see, over time, this increases and increases and increases over time. Now, were there bumps in the road? Heck yeah, there were bumps in the road. This was the 2000 crash right here. This was the dot-com crash when all the internet madness was going on. It was like $1,500 in 1999. And if you scroll down by 2002, it went down to $775. That's like a 50% drop. So had you bought here and sold here, you would have lost half of your money. That's why we're saying you need to stay invested, because had you held on, you would have recovered all of your money by now, by this date. This here was the 2008 financial crisis. Same thing happened. But what happened since then? From 2008, it just started climbing and climbing and climbing. And there are multiple reasons for why you see this big drop here. This here was COVID. If you remember, this was 2021. We had a huge crash here. It was huge. It was a massive crash. Obviously, everyone panicked for COVID, right? But then look at the run up since then. As you can see, over time, if you stay invested, it's always really beneficial. Let's take a look at some of the companies that's in the S&P 500. At number one, we have Microsoft, excellent company. The weight, when you see the weight, that means that it comprised the entire S&P 500 comprised of 6.67% Microsoft. Then we have Nvidia, then we have Apple, Amazon, Meta, Broadcom, Tesla, Berkshire, Alphabet, which is Google. Then you have the big banks, JP Morgan, Walmart, everyone's favorite shopping place, Lilly, health company, Visa. We all have a Visa card now. Oracle, Netflix, all of you with your Netflix subscriptions and stuff. These companies, really good reputable companies, when you buy into the S&P 500, you buy into these companies. So you can say, I own those companies because you own the S&P 500. So now your money is like spread across the entire US economy with you minimizing your risk. You have your money piled into like different sectors in the economy. So if anything happens in the oil sector or something, you're still safe. Yes, it may go down a bit, but you're not going to lose all your money. My strategy, I just buy it and forget it. If you, let's say you're beginning today and you started investing tomorrow, okay, and you went and you put some of your money into the S&P 500 index tomorrow, and you just take your phone, you pick up your phone and you're just like constantly looking at it, fluctuating day to day, hour to hour, and it can drive you insane. Don't do that. Buy it and don't look at it, okay? It goes down, it goes down, it comes up, it goes down, it comes up, but over time, I'm telling you, it's very beneficial. You would see your money going up. I mean, it's one of the smartest things to do, in my opinion, because one of the best investors, arguably, that any one of us, we can't argue that Warren Buffett is probably the best, one of the greatest investors of all time, right? Even he said, if you give him $100,000 today, he would put it into the index fund because no one could time the market. It's impossible. Even the best investors cannot time the market. And especially nowadays, when you're investing into the stock market, you're actually competing against all these big Wall Street firms and these Wall Street guys with these technical trading bots and algorithms, and you don't want to get yourself caught up in that. Trust me, you're going to get beat by them. The best thing to do, go with the S&P 500 or a similar index fund. There's the SPX and SPY and the NASDAQ, and I'll make separate videos on all these things very soon. So what's the risk here? Let me put it this way. The only way that you would lose money investing into the S&P 500 or another similar index fund is, let's say you buy at a certain price, you're watching it every day and you see it's going down and you panic or something and you just sell it at a lower price. Yes, you're going to lose money. But if you ignore the dip and you ignore those fluctuations, over time, it is going to go back up and you would never lose. At least that's my opinion and that's my experience for the past 15 years. Have I gone through some dips? Oh, hell yeah. Has it gone back up? Absolutely. Now you might ask, isn't like investing into the stock market like gambling in a casino? Actually, I would say it's probably the opposite. Let's take it this way. The more time you spend in the casino, the more money you're going to lose. For sure. The more time you spend in the stock market, the more money you're going to make. How could it be like a casino? It's not. It could be like a casino if you treat it like a casino. If you start investing into single stocks and you put all your money into one stock and you're hoping that it would go up today and you want to sell it by this evening and it just tanks, you're going to lose. Then you're treating the stock market like a casino. Another thing, I would not want you to put your money into an investment or the stock market if you know that for some reason you might need that money within the next 5 years or so. At least commit to 5 years to be on the safe side. This is a long-term strategy. And if you think that maybe you're thinking about making a big purchase maybe in the next year or two, I would highly recommend that you don't take that money and put it in the stock market. At least 5 years, preferably more, at the minimum 5 years. Now, could the stock market go down to like zero and you lose every single penny? highly unlikely. Let me just put it that way. If the stock market, especially the US stock market, ever goes down to zero, I think your stock portfolio might be the last thing on your mind at that time, because that is going to be like totally Armageddon, right? The world will be on fire if that happens. Chances of that happening is 0 to none, like little to none. So I would not worry about that. After years and years of doing this, I'm telling you that your future self would not regret you starting to invest right now, right this day, this minute. The sooner you do it, the better. Then the question arises like, Amit, how much would I need to like start investing? Or do I start with $1,000, $5,000, $10,000? Look, it's all up to you and your situation. Everyone's situation is different. You can start with as little as $5, $100, $1,000, $10,000. It's all up to you. Whatever you are comfortable with and whatever your life allows you to do at this point in time. Okay, so where do you invest it? The best thing I would suggest is that the bank that you already bank with, whether it be Bank of America or JP Morgan Chase or one of those other big banks, they already have platforms available to you to open like a self-directed investment account. Now, why do I say self-directed? That is a type of investment account that you can actually invest in yourself without needing like a money manager. That way you get away from the commissions and the broker fees and stuff that they charge persons who invest with them. Open a self-directed investment account and do it on your own. That way you get away from a lot of the fees. There are also online brokers I know there's like Vanguard and Charles Schwab and things like that. There are many places, depending on where you're located, what country you're located in. Do some research and see who are the most reputable firms out there and companies out there that allow investing and opening a self-directed investment account, and open one with them. Just make sure they're reputable, okay? Let's say, for instance, you're outside of the US. Well, then there are many other apps, international apps. I know there are a couple of apps that allow you to invest in different things like cryptocurrencies and the stock market and REITs and all those things. So I'll make a totally separate video on the platforms that you should or should not invest in. I'll do that pretty soon. I know we covered a lot today, but don't worry. I will very soon make separate individual videos about all the detailed points that we pointed out today so that you get a clearer picture in your mind. But today I just wanted you to get like a general idea of where you should start and what you should do in the beginning so that you don't get burnt. The last thing I want you to do is get burnt and get discouraged from investing. So that was the total point of doing this video for you today. And remember, I'm not a financial advisor, so do your own due diligence before making any kinds of investments or decisions. Now, this is the part where most people ask you to like and subscribe and all that. I'm not going to ask you to do all that. If you found some benefit out of this video and you want to be friends and speak more on a regular basis, please go right ahead, but it's totally up to you. Either way, I'm fine with it. See you in the next video. Bye.